Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I'm Arjun Patsati. In this month's podcast, we have a lot to cover, a lot of events that are affecting the bond deals, more positively than negatively at this point of time. But could it have repercussions going forward? We have to wait and see. And in this podcast, I'll be taking you through all the events that are having its push and pull effect on the bond deals at this point of time, both on government bond deals and corporate bond deals. Now, coming to the latest uncertainty, which is the fear of war, where you have the India and Pakistan at loggerheads on the terrorist attack in India, which had happened recently, and that is taking a toll on its bond markets in terms of in not exactly a toll because markets have been calm, but it's creating an uncertainty in the minds of investors on what could be what could happen if it could escalate. Now, in the last when the last threats of war or when the last war itself in terms of attacks happened, that was way back in the early 2000s when 9/11 US struck Iran, Iraq. There was sudden huge volatility in bond markets at that point of time, and that huge volatility actually had to forced bond yields to rise very sharply. But at that point of time, RBI actually didn't do really anything very negative on the to force the issue. And there was then after a initial period of volatility, there was calm afterwards. So in this particular episode as well, what we do see is that there would be, if there is an escalation, definitely there would be an impact because of the fact that investors do get nervous and tend to sell. And however, RBI would be more calm in terms of enabling more liquidity to the markets and keeping the financial markets calm rather than acting in a haste, and that should calm markets going forward. So bond yields should start if there is a sudden rise in bond yields, they should start to normalize in a while. But there would definitely, in a very short term, there would be some initial panic if there is heavy escalation of the war threat. So that is on the war front. Now coming to the tariffs, we have obviously all the tariff noise that is going around, which caused huge volatility to the markets. What we have seen is equity markets have fell very sharply, but then clawed back most of the losses. And even in the currency market, there was initial fear of rising currency, initial fear of capital outflows, but then that got negated, and suddenly the emerging market currencies, including especially India, saw very strong appreciation from lows. And so that has also, to some extent, taken out a lot of the nervousness in the markets. Then obviously the Fed had a meeting recently, which they announced on the policy front. They are seeing some kind of a stagflation that is happening in the US. So they didn't cut rates. And given that the US GDP growth in the last quarter was pretty had shown a fall, so that is also preying on the market's minds, and also the fact that if the tariffs war escalates, what could happen to the U.S. Treasury yields that are still hovering around in a 4.3 kind of a level, 4.3% kind of levels, which is showing that the markets are still a little uncertain on the long-term direction of the U.S. yield curve. So all that is obviously keeping the U.S. Treasury curve higher, steeper, and higher, and and this would mean that there could be we would have to wait and see what where would these tariff talks start to head going forward, and would that lead to any kind of normalization of economic activity globally? That uncertainty will continue to prey on the markets. In terms of RBI itself, they cut rates in April in their first policy meeting for this year. and they did cut rates and guided that the policy will be accommodative, as in any stance going forward will either be stable rates or rate cuts, not any kind of an adverse rate action by the RBI, unless specifically warranted if in case of extreme market volatility or other financial situations. But at this point of time, does not seem to be happening. So RBI, and also RBI has followed up that policy with a very large tranche of bond purchases for about 1.25 lakh crores, 1.25 lakh crores or 1.25 trillion rupees, which again making the total bond purchases in the last since February to close to around over 5 lakh crores, which is a very, very large sum of liquidity infusion by the RBI. And apart from that, in March, February and March, they did this dollar swaps where they infused about 1.7 to 1 lakh crores of liquidity into the markets through purchase of dollars through the swap auctions they had announced, and that was to add dollars to that was to prevent some any kind of worry on the currency volatility at that point of time. But suddenly you had the rupee that was touching 88 to the dollar in the last in a couple of months back, is suddenly down by very sharply to closer to 84 to 85 to the dollar. Portfolio flows have increased, and so that shows that the rupee itself is not at this point of time doesn't seem to be any concern for the RBI, and they would keep liquidity high in the system. They do want banks to start lending more to the economy to spur economic growth, and they do see inflation forecasts pretty much stable and closer to the target. Hence the policy is more accommodative than even neutral at this point of time. So clearly, what all this means is that the government bond yields have fallen from just before April policy, it was at 6.5%. Now it's at closer to 6.3%. The in the 10-year yields, and that shows that the bond markets are pretty much confident that rates are going to remain stable. It's going to hover here for a while. Two positive things for the market is obviously one is that the RBI has taken out a lot of positions from the market. So there is a huge amount of gap of 5 lakh crores, and government borrowings are expected to go through well bid and smoothly. So there is no issues on that front. And the second is that further guidance they have provided is more towards rate cuts rather than anything else. And that will keep the markets, government bond markets, well bid. That means the yields can be at around 6.3% or below slightly. But the question is, how far can it go? No, that remains to be seen. But if you see the previous actions of the government bond yields, especially during COVID when the repo rate was at 4%, still the government bond yields were very, very, very sticky. At the 10-year yields are very sticky at around 6%. So to breach that 6% widely by a wide margin and stay down would require a lot more uncertainty on economic growth and RBI being extremely accommodative, which at this point of time doesn't seem to be so. Now, seeing the trends in the current earnings season, we have analyzed over 50 plus kind of calls with managements on the results, the lenders, banks, and NBFCs. The trends are very clear. That one is on the banking side, the deposits, the credit has degrown very sharply from over 20% to around 11%. Deposits too have come off. Deposit growth have come off to below 11%. Despite the credit fall, the liquidity in the banking system has been very tight, and banks have been very had to be very sure of the cost use of money for lending, as in because of the because of the tightness in liquidity at their end. So they didn't have enough, they didn't have too much of funds to work with for lending, giving credit to the markets. But now RBI has tried to look to tighten, increase that liquidity into the banking system through both cash reserve ratio cuts and rate cuts, and through direct bond purchases and uh, dollar swaps. All this is adding on to the confidence that the banks could start to increase their lending. But having said that, then the trends in the lending space have been very clearly the banks are pretty much in a good wicket. The balance sheets are good. NPAs are down to 14-year lows at around GNPAs are close to 2.5%, and most of the lending has been pretty much well balanced. Some of the banks are seeing stress in their microfinance loans, which again shows that the whole microfinance industry has come under stress over the last 8 months to 9 months. But then, what the trends do suggest is that the most of the pain period for MFIs could be over, and a one-time cleanup by the RBI through its regulations in terms of the number of borrowers, number of lenders one single borrower can access is limited, and other such provisions, other such risk measures by the RBI to make sure there is no overlending. All that will start to clean up the system and stabilize the microfinance industry. Growth may be slow, but the quality of underwriting and lending could be higher. In other secured loan space, especially in the retail loan space, the secured loans have done pretty much well, stayed calm, no great delinquencies on that. The unsecured loans and obviously the microfinance loans have been personal loans and microfinance loans and credit cards have seen some increased delinquencies, and measures are taken by the lenders to be cautious on that front as well. The cost of funds have also is also looking our interactions with the issuers and the market shows that cost of funds are looking to drop for credits. Obviously, the fall in government bond yields, the fall in repo rate, and the high liquidity, and the banks now may not be so keen to load up on government bonds given that yields have fallen and treasury profits may not be so high. So they would look more towards looking to lend towards good borrowers, and that could mean corporates corporates could see lower cost of funds from as banks tend to reach out to them to provide loans, provide work facilities to their for their businesses. So we are seeing some very strong NBFCs now looking to access funds that hit the market at lower yields, at least down by 50 basis points to 75 basis points is where they want to access the bond markets, as they believe, as they are saying that banks are now are lowering their lending rates. But having said that, there are some stressed borrowers that are still finding rates still high, but they would have to improve the fundamentals and clean up their balance sheets before their rates could drop. So in the in all this war threat, tariff, Fed and RBI, what definitely comes out across is at this point of time, the markets are pretty much in calm waters. At least bond markets are in calm waters. G-Sec yields are holding steady at lower levels. Corporate bond yields, even in the lower rated corporate bonds, are also seeing a good amount of demand from the market, largely because of the fact that their own liquidity is pretty good because they have slowed down loan growth and have increased their liquidity, largely to ward off any kind of tightness that they saw in March the previous year because of the overall liquidity tightness in the system that has loosened up. And given that many of them are now looking at slower growth, their liquidity profile is pretty strong, capital adequacies are reasonably good, and that they would start to look more and more at lower kind of rates for their borrowings. Obviously, the stress sector, especially in the microfinance space, uh, it remains to be seen if the whole pain period is over. But if it's slowly coming to a fact that it's getting, slowly starting to reduce, to a very large extent, then and if their balance sheets are pretty clean and their business is getting better and better in terms of quality, then they could also see that they can access the markets much better. Thank you very much for listening in, and do follow us on our podcast channels.